Ladies and gentlemen, welcome to my channel Commerce Specialist. We'll find content relating to various academic qualifications and professional certifications, including life-changing business ideas and concepts. Ladies and gentlemen, today's video is focused on earning per share, how to calculate earning per share, what are intermediate earning per share, diluted earning per share, so on and so forth. This video has been prepared keeping in mind the various provisions of ASC 260, which is Accounting Standard Codifications, followed in USA for CPA and CMA exams, and IAS 33 for ACCA and CA exams. So without wasting more time, let's hit the content. So before we go into the detail, we need to know what is earning per share. Earning per share is a profit which each ordinary share or common shareholder may get if 100% of the company's profit were distributed as dividend or maybe retained. So earning per share is a profit which an ordinary shareholder gets. How to calculate? There is a formula. So let's look at first the basic formula for earning per share. Ladies and gentlemen, earning per share, the formula is like this. EPS is equal to net profit minus preferred dividend, whole thing divided by weighted average number of shares outstanding. Alternatively, you can write this formula for EPS as EPS is equal to IAC upon WANSCO. This IAC means income available for ordinary shareholders. Ordinary share and common shareholders are the same. You know there are two types of shareholders, preference and ordinary or common. So we are talking about profit available for ordinary shareholders, income available for ordinary shareholders, common shareholders, divided by weighted average number of common shares outstanding. Shares outstanding means shares which have been issued. So before we go to the nitty-gritties, the technicalities, we need to understand how is this amount arrived at? How is denominator calculated? So what I'm going to do is I'm going to put some numbers, some assumed data on the board and help you understand what is the correct way to calculate the numerator and the denominator. So once we know how to calculate the numerator and the denominator, the only thing left is we just have to plug the numbers into the formula. That's it. You'll get EPS. After that, I'll take you to the calculation of diluted earning per share as well. So let's look at how the numerator and denominator is calculated. So guys, what I have done here is I've assumed some numbers here to make you understand how we start and we arrive at the numerator for EPS. Everybody knows what is sales. Sales less cost of goods sold, I got gross profit, less operating expenses, I got operating profit. Please remember, operating profit, EBIT or PBIT is the same. EBIT is earning before interest and taxes, PBIT is profit before interest and taxes. Alternatively, you can call them operating profit. So after operating profit, the very first thing we subtract is interest. You can also call it finance cost. So I'm assuming there is a long-term liability, maybe bonds, and there is 12% interest on it. So 12% interest multiplied by the value of the bond, which maybe let's say 100,000, gives you 12,000. So from operating profit, you minus interest first, you get earning before tax. You can call it EBT, you can call it PBT, profit before tax. So this is profit before tax, assuming a tax rate of 20%. So 20% of this would give you this much, I assume. So you minus, you get net income, net profit, or earning after tax, EAT. This is not eating, this is earning after tax, or you can call it profit after tax, okay? So this is your profit after tax. Generally, when I say net profit, I mean the amount after paying interest and taxes. But that's not enough. Because this is a profit, we have to pay dividends to the preference shareholders. We always pay them first. So I'm assuming that we have 4,000 preference shares. Each share has a par value of 2. So when you multiply, you get the value of preference shares, and the dividend they carry is 10%. So from net profit, when you minus the dividends for preference shares, what you're left is the amount of profit available for ordinary shareholders or common shareholders or common stockholders. And this is the numerator. The formula for EPS, as I told you, is EPS is equal to IAC. IAC means income available for common shareholders, which is this amount. Divide by weighted average number of common shares outstanding. So yes, I have the numerator. This is 142,400. Now the question is, what is the weighted average number of shares? Here again, guys, I am giving you the detailed calculation of all the possibilities to calculate weighted average number of common shares outstanding. Common shares outstanding means shares which have been issued so far. So what I'm going to do is, I'm going to include some activities, I'm going to include some transactions of shares, and looking at them, I will explain you how to calculate the weighted average number of shares outstanding. So let's look at the example. So guys, I've given you some details here. The company has made some transactions relating to shares, and looking at those transactions, we will calculate weighted average number of common shares outstanding. Common shares, common stock, ordinary shares are the same. So if you look at the first one, it says on January 1st sold 20,000 shares. Please understand, I'm writing here January 1st. We are selling 20,000 shares. Because we are selling shares on January 1st, that means that shares will qualify for the whole year of dividend. So it is assumed that the company's year end is December 31st. So if the shares are sold on January 1st, they remain outstanding for the full year. So any shares which is already there on January 1st from previous year or sold on January 1st this year, they qualify for the whole year of dividend. Which means shares which are sold on January 1st, so I can write here like this. January 1st you sold 20,000 shares. Actually, you multiply them by a fraction 12 upon 12. That means they qualify for the full year of dividend. So they are equal to how many shares? 20,000. Likewise, if you look at the second one, it says March 1st. You're selling shares on March 1st. So on March 1st, again you're selling shares, 30,000. But here you need to remember, you're selling on March. So from counting from 1st of March, March, April, May, June, July, August, September, October, November, December. So shares which were sold on 1st of March, they remain outstanding for 10 months. So I'm going to multiply this by 10 over 12. And they will be equal to some number of shares which I'll just calculate now. Likewise, you're purchasing shares on May 1st. This is very important, guys. May 1st, you are purchasing your own shares, which is known as treasury stock. So let me write it, treasury stock. When a company buys their own shares from the market, that's known as treasury stock. Treasury stock. You're buying 18,000 shares. So guys, if you look at this till this part, I'm going to explain it again, because these fractions you need to understand very carefully. On January 1st, when you're selling 20,000 shares, so 20,000 shares, January to December, full 12 months, I multiply by 12.12. So they are equal to 20,000 shares. Then on March 1st, I'm selling 30,000. So from March 1st right up till December, if you calculate March, April, May, June, July, August, September, October, November, December, 10 months. So it's 10 upon 12. So they are equal to 25,000 shares. I'm giving the weightage as per the number of months they were outstanding. Then on May 1st, treasury stock is purchased. 18,000 treasury stock. Treasury stock means you're buying your own shares. When a company buys their own share from the market, we call it treasury stock. So alright, when is the day? The day is 1st of May, you're buying treasury stock. So from May onwards, the shares were not issued, not outstanding, they were with the company actually. So counting from May right up till December, so May, June, July, August, September, October, November, December, 8 months. 8 months, these shares were not outstanding. Because if they were not outstanding, I am taking this as minus. They were purchased back, they were not outstanding, they don't qualify for the dividend then. After that, it's January 1st, we sold 12,000 shares. Because it's on July 1st, sorry, we sold on July 1st. So from July to December, it's another 6 months. So 12,000 shares, they are worth 6 upon 12, 6,000. Now everybody please pay attention. We are coming to stock split. What is stock split? Stock split is when a company divides its existing shares into number of shares. Let's say a share is for $10. Company can go for a stock split of 2 for 1, which means earlier the share was for $10. Now they will have 2 shares worth $5. So the number of shares generally increases when a company goes for a stock split. So here it says stock split for 2 for 1. Every 1 share is now divided into 2. Okay, so there is a stock split on 1st of August. So I'm writing here August 1st. August 1st, stock split. Stock split. And whenever there is a stock split, all these shares before the stock split should be multiplied by this 2, because all shares are now converting into 2. So all this I am writing here adjustments for stock split. SP is stock split. So I am just multiplying them by 2. You understood? Whenever stock split takes place, our assumption is that all these shares, previous shares, are also obviously divided into 2. So stock split, the effect is retrospective. That is from the beginning of the year. Not when they were done, but it applies to all the shares issued before stock split. So all this is done. After stock split, we are selling 48,000 shares. So if you are selling 48,000 shares, what's the date? It's on September 1st. So on September 1st, we are selling shares. We sold shares, 48,000. So 48,000 shares. Obviously, we are selling on September. So from September to December, September, October, November, December. So that's 4 months. It should be 4 upon 12. So this should be equal to 16,000 shares. And these will not be multiplied by 2. Why? Because these shares are after the stock split, so they are the new shares. Alright, after that, alright, 1st of November, we are declaring a stock dividend of 10%. Please, everybody, this is an important step. When a company declares stock dividend, that means instead of paying cash as dividend, the company is giving shares to their existing shareholders. So whenever a stock dividend is declared, it applies on all the shares which have been issued so far. Means a retrospective treatment. Retrospective here, what I mean by retrospective is, although the stock dividend is declared on 1st November, but it will apply to all the shares from the beginning. We are assuming as if the stock dividend was done at the beginning of the year, just like stock split. If we talk about the stock dividend, it's declared on November 1st. I'm writing here November 1st, stock dividend declared at 10%. So what effect would will have? It will have an effect. 10% means we have to increase all the amount by 10%. So I'm writing here adjustment for stock dividend. I will multiply, if it is 10%, I will multiply all this by 1.1. Okay. This is the effect stock dividend has. All the shares which have been issued before stock dividend, you just increase them by 10%. If I have to increase them by 10%, I'll multiply by 1.1. If the stock dividend is 20%, I'll multiply all these shares by 1.2. Moreover, anything else? Yes. Finally, we're selling shares on December 1st. So December 1st, we sold shares, additional shares. How many? 24,000 shares. And because we're selling on December, so the shares remain outstanding for just 1 month. So it is multiplied by 1 upon 12, and they'll be equal to 2,000 shares. Finally, we have to multiply all these shares to work out the weighted average number of common shares. So I don't have space here, so excuse me, I'm going to write a little small. So guys, 20,000 into the fraction is 20,000 into 2 into 1.1. So 20,000 into 2 into 1.1 gives me 44,000 shares. After that, 30,000 into this fraction into is equal to 25 into 2 into 1.1. So 25 into 2 is 50,000 into 1.1 gives me 55,000. 12,000 into 2 is 24 into 1.1 is 26,400. Here please pay attention, because these are treasury stock, they will be subtracted. Shares of treasury stock are also subtracted from all the shares. We always subtract them, right? Keep this in mind. So 6,000 into 2 is 12,000 into 1.1 gives me 13,200. 16,000 into 1.1, 17,600, and 12,000 and nothing is 2,000. You add this, please. So when you add this, 44,000 plus 55, 99,000 plus 13,200 plus 17,600 plus 2,000 minus 26,400, which was for treasury stock. So I'm getting 105,400. This is the whole word, you can call it weighted average number of common shares outstanding. So these many shares, which means here the Vansco, this is a short form, we can call it Vansco, or you call it anything. Actually, these are weighted average number of common shares outstanding. So your income available for common shareholders is 142,400. Your weighted average number of common shares outstanding is 105,400 shares. So how much do you get your EPS as? So it's 142,400 divided by 105,400. It comes to 1.35 per share. You can say EPS is $1.35 per share. Guys, now I'm summarizing. Any share you issue, look at the date when you are issuing it till the year end. If you're selling, just count the number of months from the date of issue till year end and give it a fraction like this, multiplied by the fraction. If it's on the beginning of the year, 1st January to December, full year, that means 20,000 shares are worth 20,000 shares. If it's issued somewhere during the year, then you have to calculate the fraction, just like you can calculate in depreciation. 9 months depreciation, 10 months depreciation, 6 months depreciation. Exactly the same fractions I'm using here. But what you need to remember is, if you're buying treasury stock, you have to minus them. Buying treasury stock means there are no more outstanding. So if you look at the May 1st transaction, we are buying treasury stock 18,000. We are buying it on 1st May. So from May till December, they were not outstanding. That is 8 months. So this 18,000 multiplied by 8 upon 12, they are equivalent to 12,000 shares. But I minused. Why? Because there are no more outstanding. We have purchased them back. After that, if you're selling shares, same thing happens. We are selling. We are selling on July 1st, 12,000 shares. From July to December, 6 months. That's why I used a fraction of 6 upon 12. So shares issued on July, even they are 12,000 shares, but they are equivalent to 6,000 shares when it comes to dividends, when it comes to remain outstanding. Then comes stock split. I told you already, stock split means dividing your existing number of shares. If I have one share of $10, 4-for-1 stock split would mean one share of $10 is now equal to 4 shares of $2.50 each. So it says here, company made a stock split on 1st of August. So all the shares which were already issued before the 1st of August, stock split is going to affect them. That's why if you look at this adjustment for stock split, I multiplied all the number of shares which were issued before the stock split. If it's 2-for-1, I multiply all the shares by 2. If it is 4-for-1, I multiply by 4. Okay? After that, again, I kept selling shares. On September 1st, sold 48,000 shares. Because it was sold on September 1st, we need to calculate right up till December. To September to December is 4 months. That's why I gave this fraction. So 48,000 shares, because sold on September, they will only be equal to 16,000 shares. After that, we are declaring a stock dividend of 10%, 1st November. Stock dividend means you are giving dividend to existing shareholder, not in the form of cash, but in the form of shares. So your shares are increasing. And all the previously issued shares, they qualify for stock dividend. That's why I did this adjustment for stock dividend. All shares sold already before the stock dividend, I am multiplying it, increasing them by 10%. To increase them by 10%, I am multiplying by 1.1. If it was 20%, I multiply by 1.2. If the stock dividend was 30%, I multiply all the shares issued so far by 1.3. So here it was 10%, that's why 1.1. But any shares issued after stock split, after stock dividend, will not get the treatment of 1.1 or 2, just as these. These only apply to shares issued before declaring stock split. All shares issued after the stock dividend or after the stock split, we do not do this adjustment. Just like the one here, December 1st, sold 24,000 shares. So I'm selling 24,000 because I'm selling on 1st December. So it will qualify only for 1 month, 1 upon 12. So it is equal to 2,000 shares. Although it is 24, but because it remained outstanding for just 1 month, so it is as good as 2,000 shares. In the end, I'm going to add all the shares, but subtract the treasury stock shares. I get my weighted average number of shares. So remember the formula, income available for common shareholders divided by weighted average number of shares. Income available for common shareholder is calculated here. I took it in numerator, weighted average number of shares, I divide, and I got earning per share, which is $1.35. Guys, now what? What happens as per IAS 33 and Accounting Standard Codification ASC 260, all limited companies are supposed to show on the face of their financial statements 2 types of earning per share. One is known as basic earning per share, which is this one, which is a normal earning per share, and the other one is diluted earning per share. Diluted earning per share means what happens if the denominator, that is weighted average number of shares, if they increase somehow, and if they do, obviously your earning per share will go down. We call it diluted earning per share. So what we are going to discuss now is what are the events because of which the weighted average number of shares may increase and your EPS may dilute. So ladies and gentlemen, let me tell you, there are 3 possibilities generally. One is stock options and warrants. If these options are exercised, the number of shares will increase. The denominator will increase in the EPS. Sometimes there are some preference shares which are convertible into common shares, ordinary shares. If that happens, the numerator will increase. There are certain bonds, long-term liabilities, which are convertible bonds. After certain time, they may convert into ordinary shares. If that happens, yes, the denominator will increase. I told you about three possibilities: warrants and options, conversion of preference shares, conversion of bonds. Please remember, when warrants and options are exercised, when they convert into shares, the only effect is on the denominator. But when preference dividend and convertible bonds, they convert into shares, the effect is on the numerator as well as on the denominator. So I'm going to explain you how options, convertible preference shares and convertible bonds dilute the EPS. So let's look at them. So guys, I've given you some basic information here using which we will be able to calculate diluted earning per share. What we are looking at is there are some preference shares and bonds given here which are convertible. So we are looking at the what if analysis. What if they convert? If these preference shares and bonds convert into ordinary shares, how the EPS will look like? Will it dilute or not? Will it reduce or not? So for example purposes, I have already assumed that we have weighted average number of common shares, which is 50,000 shares, and income available for common shareholders is given. So this is just given to us. We have the weighted average number of shares, we have the income available for common shares, and basic earning per share calculated here. That is income IAC divided by weighted average number of shares. Basic earning per share is calculated as $2. Now we are looking at the possibility. We call it potentially convertible shares, potentially be convertible instruments. It could be shares or bonds or warrants. So at the moment I'm just talking about two. The first one, it says there are 8,006% preference shares having a par value of 10. They may convert into 3 ordinary shares. So what we are looking at, if preference shares convert into ordinary shares, what will be the EPS effect? By EPS effect, I mean how it's going to affect the numerator and how it's going to affect the denominator. So let's have a look. We're talking about preference shares converting into ordinary shares. So the first one, there are 80,000 preference shares, okay. Each share has a par value of 10, okay, multiplied by 10. So they're equal to 800,000. This is the value of shares. Please remember, preferred dividend is paid on the par value. Number of shares multiplied by par value. So that is 800,000. 6% is the dividend paid. So you multiply by 6% will give you 48,000. Ladies and gentlemen, this 48,000 is the preferred dividend, which now you will not pay. Why? Because the shareholders are no more preference shareholders. So if they convert into ordinary shares, they will have to forego their dividends of preference shares. So ladies and gentlemen, if the preference shareholders convert to ordinary shares, we are saving on the preferred dividend, which is how much? 48,000. So okay, this is one saving. Now we are looking at this saving means obviously it will be added here. Your income will increase. I'll tell you how it is done. Now we are looking at if they convert, how many shares would they convert into? How many new ordinary shares will now be outstanding? So if you look at, it says there are 80,000 preference shares and they convert into 3 ordinary shares. So 80,000 shares will convert into 3. So there will be 240,000 new shares. Therefore, guys, please note, therefore the EPS effect in the numerator, it will increase by 48,000 savings and new shares will be issued 240,000. So if I divide 48,000 by 240, your EPS is coming to 0.2. Your EPS effect is 0.2. Now please pay attention to this. I have only calculated the EPS effect if preference shares convert into ordinary shares. We also have to calculate EPS effect for bond conversion. So that I am doing here. EPS effect of bond conversion. What happens when bonds convert? So if you look at, there are 4,000 bonds. So there are 4,000 bonds. Each bond has a par value of 100. So if I multiply, I'll get 400,000. That's the value of bond. Please remember, interest is always calculated at the value of bond. So value of bond is 400,000. Interest rate is 15%. So when you multiply it by 15%, how much you get? 400,000 into 0.15, it gives you 60,000. Now 60,000 is your saving in interest. So what we do is we multiply this by 1 minus tax because we want the saving after tax. So 60,000 into 1 minus tax is 40%, which means 0.4. So this will be 60,000 into 0.6, which will give you 36,000. 36,000 is the net after-tax saving for interest. Why? Because if the bonds convert to ordinary shares, now they are not bondholders, they are shareholders. They are not lenders, they are the owners of the company. So we are not paying the interest. We are not paying the interest, we are saving the interest. How much we are saving after tax? 36,000. Another thing we need to see is how many shares these bonds are converting to. So it says there are 4,000 bonds in the question. 4,000 bonds are there. Each bond will convert into 20 shares. 20 shares. So we will have 80,000 new shares if the bonds convert. So finally, we need to see the EPS effect. So the EPS effect is actually, numerator you are saving 36,000. Denominator you will have 80,000 more shares. So when you divide 36,000 by 80,000, you will get 0.45. Now one thing is very important, ladies and gentlemen, you need to remember is, see the EPS effect of preference shares, it's 0.2, and the EPS effect for bonds is 0.45. We have to rank them from lowest to highest. From lowest to highest. What does this mean? This is a very important step in calculating EPS. First, you calculate the conversion. As a result of conversion of preference shares, how much you are saving in preference dividend? 48,000. How many new shares? 240,000. What is the EPS effect? 0.2. Conversion of bonds, how much you are saving in terms of interest. If the bonds convert, you are saving 36,000 net of tax. How many new bonds? 80,000. When you divide 36 by 80, you get the EPS effect 45. Look at both, 0.2 for shares, 0.45 for bonds. Rank them from lowest to highest. Lowest first, highest second. Now what is this first and second? Where we are going to use it? We are going to adjust them to our basic earning per share. So have a look at this. I am looking at the conversion of preference shares first. I am going to adjust. Please understand, my basic earning per share, which is known as BEPS, was 100,000 divided by 50,000 shares, which was coming as $2. Now I am going to incorporate these, numerator added with the numerator, denominator added with the denominator. So I call it intermediate earning per share. Same numerator, 100,000 was the earning available for common shareholders. Now because the preference shares converted, you have additional earning of 48. So let's add 48,000 here. In the denominator, you had 50,000 weighted average number of shares already. Now that the preference shares converted, you have 240,000 more shares. So you have 240,000 here. So when you solve this, this is 148. So let's do it here. It's 148,000 in the numerator. In the denominator, you have 290,000 shares. So what is the new EPS coming to? And is it reducing? Let's check. So you have 148,000 in the numerator. You divide it by 290,000. You get 0.51 as your EPS per share. So if you notice, it was 2 before, now it has gone down to 0.51. The EPS has diluted. How? As a result of preference shares converted. These are preference shares converted. This is not the end of the story, ladies and gentlemen. Now we have to incorporate the effect of bonds converting into this. What happens? Is the EPS falling further down or not? Let's have a look. So if I use a different marker here. Now at the moment these are the intermediate EPS figures. So what I'm going to do is, I'm going to use the same 148,000, but add the numerator for EPS effect over here, 36,000. So 148 already after the conversion of preference shares. Now another saving of after tax interest, 36,000. So let's put 36,000 here. In the denominator, you already had 290,000 shares after preference shares being converted. Now you have another 80,000 shares after bonds being converted. So let's incorporate that here, 80,000. So finally it comes to how much? In the numerator you have 148,000 already plus 36,000 after tax saving of interest. So you're getting 184,000. In the denominator you already have 290,000 shares plus 80,000 more shares as a result of bonds converted to ordinary shares. So 290. So you're getting 370,000 here. So when you find the EPS now, 184,000 divide by 370,000, you're getting EPS as $0.498. So ladies and gentlemen, if you have a look, before it was $2. As a result of preference shares converted, the EPS fell down, it diluted to 0.51. Further, when the bonds converted to ordinary shares, from 0.51 it came to 0.49. So it's still going down. This is finally your diluted earning per share. So guys, this example was when you already have a basic earning per share, and if you have preference shares and bonds potentially converted. Please remember one thing. Even though the question says that the preference shares are not yet converted, the bonds are not yet converted, what we do is we follow prudence. Prudence is, what if they are converted? If they are converted, worst come to worst, what's going to happen? What's going to happen to a basic earning per share? If the shares and bonds do convert, if the EPS will fall from $2 to 0.5, 0.5 to 0.49, and this final is your diluted earning per share. And this is a requirement of IAS 33 and the requirement of ASC 260 for earning per share. Ladies and gentlemen, now I'm going to give you another example where when we calculated dilutive earning per share, we find that it is anti-dilutive. So what is anti-dilutive? Let me show you. So example as before, we have common shares, 50,000 shares, income available to common shareholders, 100,000. Basic EPS is already calculated. 100 divided by 50,000 is $2. Now what we are looking at is the potentially converted instruments, which are preference shares and bonds. I've changed some numbers to explain you the concept of EPS being anti-dilutive. Anti-dilutive means when we incorporate the change of conversion, instead of EPS going down, it's going up. So let's have a look at it. So the first one, it says there are preference shares. Let's look at the EPS effect, because I've already explained you how to calculate EPS effect. So I'm going to go a little faster. There are 40,000 preference shares. Each share has a par value of $5. So that gives you 200,000. Okay, that's the value of shares. On the value of shares, you get dividend, which is 9%. And I think that will be 18,000. Yeah, 9% of 20,000, 18,000. So that's the saving in preferred dividend. Saving of preferred dividend. Why? Because if the preference shares convert into ordinary shares, you no longer have to pay, you're no longer required to pay the preferred dividends. Now let's look at the number of shares. It says each share convert into 6 ordinary shares. So there are 40,000 shares, each convert into 6. So that will be 240,000 new shares. So the EPS effect will be 18,000 divided by 240,000. So your EPS effect comes to 18,000 divided by 240,000. It's 0.075. This is very important because we need to rank them. Now after this, I'm going on to the conversion effect of bonds. So it said there are 4 million bonds. Okay, the value is given. It is interesting, the value of bond is already given, 4 million. And there are 12%. So 12% is the interest. 12% on 4 million is how much? So that is 480,000. Always remember, when you're converting bonds, you're looking at the interest which is saved. You have to multiply it by 1 minus tax because we need after tax saving. So this is 480,000. 1 minus tax rate is 30%. So tax is 0.3. So 480,000 would ultimately be multiplied by 0.7. So 480,000 into 0.7 will give you 336,000 of net of tax saving. So how many shares they convert into? These bonds will convert into 2 shares, but it says each bond will convert into shares. Each bond means we need to know the number of bonds. So for that, you divide the value by the par value. So there are 4 million bonds. The value of bonds is 4 million. Each bond is 400. So how many bonds do you have? You will have 40,000 bonds. That's how you calculate the number of bonds. Value of bond divided by the par value of bond, the nominal value of bond. So there are 40,000 bonds. Each bond convert into how many shares? 2 ordinary shares. So you will have 80,000 new shares. So if I look at the EPS effect, the EPS effect for conversion of bonds, earning is 336,000 net of tax divided by 80,000 new shares, which will give me 336,000 divided by 80,000. It gives me 4.2 is the EPS effect. Ladies and gentlemen, based on experience, let me tell you, we ranked them from lowest to highest. This is the first one and this is the second one. A high EPS effect most likely will cause the EPS to be anti-dilutive. Anti-dilutive means instead of reducing, it will go up. The EPS will go up. So let's see whether it is anti-dilutive or not. Let's incorporate the effects. As I told you, my basic EPS was this, $2. 100 by 50, already given. Now I am incorporating the effect of conversion of preference shares. So I'll take same 100,000. I'm calculating intermediate earning per share. I'll take this 100,000 income as before, but add the savings which we got here in the EPS effect, 18,000 of preference dividend. So I'm adding 18,000. Divide by, I had 50,000 shares already. Now 240,000 more shares as a result of conversion of preference shares. So how much do you get now? In the numerator you have 118,000, down you have 290,000. So your EPS is coming how much? 118,000 divide by 290,000. You get $0.406 or 407, whatever. Yes, it is going down. It's dilutive. If preference shares convert to ordinary shares, the EPS is diluting. It's going down from $2 to $0.4. Now we need to have a look at the effect of bonds. What if bond convert? Will the EPS will go down further, or it will become anti-dilutive, means it will increase? So let's have a look at this. I'm taking the numerator and denominator same, 118. But I will add the savings as a result of bond conversion, which is 336,000. So numerator added to numerator. Denominator, I already had 290,000 after preference shares being converted. Now I have another 80,000 shares after bonds being converted. So what does it looks like? 118 plus 336. The numerator is 454,000. Denominator is 290,000 plus 80,000. You're getting 370,000. So now when I calculate the EPS, is it increasing or decreasing? That's a very important point. So 454,000 divided by 370,000 gives me $1.22. Now look, ladies and gentlemen, from $2 the EPS went down. It became this much. But when the bonds converted, it brought a good news for the business. Why? Because from 0.4 now it is increasing. Because it is increasing, so I can write here a comment. Since new EPS is 1.22, therefore it's anti-dilutive. So in the exam, this is not your final answer 1.22. You have been asked to calculate diluted earning per share. This will be your answer. This is your diluted earning per share. Being prudent, if the share value, the EPS goes down, we show that, we disclose that. If it is increasing, that's something future. Prudence concept says future profits are not to be recorded. So and we are looking at the potentially converted instruments. Up till now, the assumption is that if they convert, they have not converted yet. So if they are not converted yet, why should we show a rosy picture? So because from $2 it became 0.4, from 0.4 it is increasing. Where it is increasing, we stop, and we stop here. This is not my diluted earning per share. In fact, from being diluted, it is anti-dilutive. I will stop here, and this is your final answer. So if you get a question like this in exam, you got to stop here. You do the working, but if it's anti-dilutive, if the EPS is increasing, you don't take that effect. Stop here when it's being diluted. Ladies and gentlemen, the last one is of options and warrants. It's not going to take much time, but it does come in your exam, so it's better to learn how to calculate. Very simple calculation. Have a look at it. So guys, first of all, before we go to options and warrants, you need to understand what they are. As the word says, options. Sometime a public limited company may give incentives to their staff. Most of the time, the directors. If I'm XYZ company, the market price of my shares outside is $30 maybe. But because the directors are doing so well, they are helping the company, they're managing the company, we give them an option to buy the company share just for $10. And sometime this option is not immediately exercisable, maybe exercisable after 6 months or 9 months or a year. So what is important to note here? The company has given an option to somebody, and that somebody may exercise the option, may avail the opportunity. And if that happens, what happens? They will buy share. And if the company sells share, that means more shares will be outstanding. If more shares will be outstanding, the numerator here will change. Earlier we had the same, look, 100,000 divided by 50. These are shares, weighted average shares. So if the option holder, it could be the director, president, an employee of the company or anybody else, if they exercise the option, that means they will be buying shares. If they will be buying shares, the company will be selling shares. If the company is selling shares, that means the denominator here will increase. More shares will be outstanding. So now what we are looking at, what if, again, whether the person has exercised the option or not, we will assume as if they have exercised the option. So if that goes through, if they exercise their option, what happens? How EPS is affected? Keep this in mind. Whenever options are exercised, only there is an effect. The effect is only on the denominator, not on the numerator. So few things are to be understood. First of all, the option exercise price. It's given here. It says option given to one of the directors to buy 40,000 shares. So option is they may buy 40,000 shares only for $10. Pretty decent and lucrative option, I would say. It's a pretty decent option, 40,000 shares for 10, whereas outside the market price could be very high. And you're given the price of the company share was this. At 1st January, it was 22. On December 31st, it was 32. Average price is 27. Now, ladies and gentlemen, comes the calculation. What we are given is, what is the option? Option to buy 40,000 shares from the company. What is the option price? 10. So if he wants to buy the shares now or later, most of the time later, he will just pay $10 for each share. Okay. How do we calculate the effect on EPS? The very first thing under options you have to look at is cash received. Obviously, if the director or president is buying 40,000 shares, they are paying the company money, right? So how much cash is received? 400,000. This is the first thing to look at. Okay. Okay, the person has exercised the option. The shares are not free of cost at a discounted amount. How much money the company is getting? The company is getting 400,000. Our another assumption in case of options is, when the company gets the money, what do? They will like to buy their own shares from the market, which are treasury stock. And when they do this, how much they buy it from? How much they buy it from the market? At the average price. So average price is $27. So yes, the company sold the option. We are assuming if the person exercises the option, they will buy shares, company get the money, company get this much, and with this much, if one share of their own share is in the market for $27, how many shares they will be able to buy? 400,000 is the money they collected by selling the shares through the option, divide by 27. So they'll be able to buy 14,815 shares as treasury stock. Treasury stock. Now what we have to look at, the net numbers. Look at this. Shares sold for option. Okay. The directors bought. Directors bought means we sold. We mean the company. We sold 40,000 shares. But at the same time, the money which we received, we also purchased some treasury stock. So you minus the treasury stock from it. We also purchased, we sold 40,000 shares, but we purchased 14,815. So net, how many shares did we issue? 40,000 minus 14,815. 25,185 shares are issued when we talk about options. In this scenario, we sold 40,000 shares. The money which we received, we also purchased some shares with that money. So 40,000 shares sold, 14,000 shares something purchased. Net how much we sold? Net this much we sold. So now when I calculate the diluted earning per share, what I'm going to do is the numerator remains the same. Remember please, in options there is no effect on the numerator. The only effect is on the denominator, which is weighted average number of shares. So we already had 50,000 shares. Now, as a result of selling the options and buying the treasury stock, what is the net effect on the number of shares? We are getting 25,185 more shares being issued. So what is it coming to? 100,000 divided by 75,185. It gives you a diluted earning per share of how much? 100,000 divided by 75,185. It gives you a diluted earning per share as 1.33. And it's very much diluted. See, it was $2 before. After the stock options which have been exercised, it is 1.33. So this is your answer for diluted earning per share, 1.33. Ladies and gentlemen, note of caution. When we talk about options, see the word says option. For this director, it is not mandatory to buy the shares. An option is given. If he wants, let's say after 6 months, if he wants to exercise the option, he can buy 40,000 shares paying only $10. Now, sometimes they tell you that at the time of exercising the option, the market price of the share is just $2. Do you think the director will buy the shares from the company still for 10,000 or will buy from the market for $2? Obviously, only a fool on earth will buy a share for $10 when they can buy it from the market. As I said, option is given by the company. If he wants, he can exercise the option. If he wants, he can just let it go. So if I'm that one of the directors, I'm given an option to buy shares at $10, but at the time when I want to buy, if the shares are available in the market for $2, might as well I'll buy for $2 a share. Why $10? So I will let go, I will lapse the option, I will let it go, and I will buy from outside. So sometimes in the question it is given like, situation like this, that the exercise price is $10 and the market price is $2, that means this option will never be exercised. Only a fool will exercise that option, buy a share for 10 when they can buy it outside for $2. Another thing to note is, whenever we are talking about options, as already said, options only affect the denominator for EPS calculations, not the numerator. And that's all about it, ladies and gentlemen. And that's all, ladies and gentlemen, for this EPS calculations, diluted EPS. I tried my level best to explain you most of the things. The video is getting very extensive now, so I'm just limiting my discussion to this. I explained you most of the important content. What is EPS? What is the formula? How to calculate the numerator, that is earning available for common shares. How to calculate weighted average number of shares. I give you all the calculation for normal shares, treasury stock, stock split, stock dividend. Okay. I gave you the options of how to calculate EPS, diluted EPS when preference shares are converted, when bonds are converted, what if it goes anti-dilutive, and the effect of options and warrants. Guys, if you've liked this video, please leave your comment. If you have any further questions relating to IAS 33, ASC 260, that is earning per share actually. If you have any queries, please put it in the comment box. I will respond to that as usual. And if you like this video, please share it with your friend and family members so that others can also benefit. Ladies and gentlemen, thank you so very much for your precious time.